Coming up in today's video, we'll talk about gold, which is sinking lower here this morning, down 1.7% at the time of recording this. And the dollar continues its huge rise that we've been seeing in recent weeks. And is the stock market pullback going to turn into more than that? We'll take a technical look at the NASDAQ and the S&P 500, and we'll talk about the crypto crash, which still seems to be going on in the altcoin world. As we get started, make sure to hit the thumbs up button, subscribe to the channel if you're new, and let's get right into it. And remember not to miss out on our biggest discount of the entire year. We're currently doing our Black Friday sale on the Edge Finder. We run this all month to give people time to prepare for it, but just so you know, this is the biggest discount that we do all year long, and you can get anything in our store for 40% off. So you can get access to the Edge Finder, to the stock box, or to our VIP group if that's something that you're interested in. For details, you can click the link in the description down below. You can also find the promo code there, or if you need further help, or if you need to set up a payment plan or need more information, feel free to chat directly with us using the link in the description or scanning the QR code that you see on your screen right now. So it seems like gold prices are continuing their higher time frame pullback. We've seen an incredible run up in gold prices this year, and it's been an awesome story. The idea of rate cuts coming, uncertainties around the trade war dynamics, the Trump administration, etc. We've seen a huge rise in the price of precious metals. However, we've recently seen some of those same stories retrace a little bit. In terms of the macro fundamental outlook, we've seen a stronger dollar off the idea of the US economy holding up a little bit stronger than expected and stronger than relative peers. What you're looking at is GDP growth projections going out into 2026. And what you'll see here is that the big blue bar is the US. GDP growth projections for the US, you can see, are head and shoulders above the rest of our G7 neighbors. And the reason I think this is important to bring up is that if you're somebody who is incredibly bearish the dollar, one of the biggest pushbacks I would give you on that is that the US economy is still the strongest growing of the major economies. And if we also take a look at interest rate projections, you can also see that the US is expected to cut interest rates, but it has one of the highest interest rates. You can see the red is the US relative to its peers. So the UK is the only one that seems to be projected to keep interest rates around the same as the US, but other places are offering lower interest rates. And just a quick reminder that when the central bank of a economy is hiking interest rates or holding them steady at high levels, that's perceived as bullish for the currency. And vice versa. If a central bank is cutting interest rates, that is considered bearish for the currency. But we know that the Federal Reserve is still cutting interest rates, so why is the US dollar going up? Well, remember, the market is forward-looking. If the market over here was expecting us to cut several more times into year's end and into 2026, but now the market is saying we may not get as many rate cuts, you can see why the dollar has strengthened. We've heard from several Fed officials that they are more of a divided Federal Reserve than previously expected. What I mean by that is that some think we should cut interest rates and others think that we should wait to cut interest rates. And this divergence from everyone seemed keen on cutting interest rates to now there's a divided group has really caused the dollar to strengthen. We are sitting at a major level of resistance when looking at the daily chart for the DXY. We're sitting at that 100 level. So I would encourage us to really watch this level closely. If you get a head and shoulders break above this, not necessarily head and shoulders pattern, but meaning a significant break above this prior high, this could send the dollar up to our next major area of resistance, 101.5. Again, over here, everyone was pretty sure the Fed was in unison for the most part that they were going to cut interest rates into 2026. What's happened since then is now we aren't so sure how many rate cuts we're going to get. And even the December upcoming meeting where they previously were pretty expected to cut interest rates has changed a little bit. Let me show you. For the 10th of the December Fed meeting, we are seeing a 71% chance that the Federal Reserve will cut interest rates from where they currently sit by 25 basis points down to 3.5 to 3.75% as a target rate. But previously this number was much higher. So it's actually come down from where it was. So while we previously were pretty much locking in a rate cut, we're now starting to see a divergence where we might not get a rate cut. Of course, this is largely dependent on economic data, which we're still in the blind on due to the government shutdown still taking place. And according to Polymarket, which is a betting market, we can see that the government shutdown, of course, there are people betting on this. There are people betting on everything nowadays. The November 16th or past that is still the favored to win odds. Now, it is pretty divided here. You've got some differing views, but for the most part, the point is people are still betting and expecting the government shutdown to persist into November. Now, in yesterday's video, I mentioned that I was short on gold. We can see that we have so far held this area of resistance, and I have chosen to trim my stop loss inside of our VIP signals room. Here's the trade update that I sent this morning. I just mentioned that I was trimming my stop loss slightly to reduce my initial risk. I shared a screenshot where you can see I trimmed my risk just above this prior high, and now we're sitting in about a 1-to-1 risk to reward trade at this moment. But the trade is still young, and while we've been right in the initial reaction here, I am looking for a bigger push to the downside on gold. And if we can get a push down to this level, what I'll be looking to do is trail that stop loss further into profit. But so far, the gold trade seems to be going as planned. And again, it's too soon to say anything further than that because we could reverse higher here, put in a higher low, and well, actually, I guess you kind of had a lower low here, but I would really say the iconic point where we can say, okay, sellers have really taken control would be if we can close below this 3,900 level. But just as a reminder, on a longer term basis, I'm still bullish on gold. I just think that in the short run, we still have room to continue to trend lower into year's end. And as I discussed in my video yesterday, if I'm completely wrong on that, then I will take a small loss. I'm short GLD, which is the Spider Gold Shares ETF. It essentially tracks the performance of gold, but as a US trader, my options for trading gold are a little different than people outside of the US. I could also trade futures, but I kind of like trading ETFs and stocks and options all in the same place, so I just do it in my main brokerage. But for traders outside of the US, let me tell you about a cool offer that one of our sponsors here is currently doing. You can currently get a free copy of the Edge Finder with our sponsor, 8cap. If you head over to our website, a1trading.com/8cap, you can actually take advantage of this offer that they are currently doing with us. 8cap is a regulated brokerage. You can trade directly on TradingView. They have low trading fees, and you can trade pretty much everything from forex pairs, cryptocurrencies, commodities, indices, and stocks. You can trade over 800 different charts. It's a global brokerage, and they also have educational content as well. Here's how it works. Essentially, if you navigate specifically to this page, you have to use the link on this page for this offer to qualify you. You scroll down and you choose which package or which kind of deposit you're willing to make. Pick your package. Step 2, open an account. Use specifically with this link here. Deposit the amount, and our team will be able to set you up with free access to our products. Again, within the realm of this kind of deposit range. And like I said, all the information for this can also be found linked in the description down below this video. And so far, as I'm recording this video, you can see the NASDAQ is showing a little bit of signs of life here. US stock market just opened up. I am long QQQ, and I've been mentioning, as I did in today's live stream, the Qs have come down to test this gap open. Now, I've been doing more of this on my channel, but I've traded, SPY, QQQ, the ETF variation for a long time. But I've incorporated more into my analysis on these videos because I actually think that the gap tells us an important story. We gapped open the prior week's trading sessions, right? We gapped open, and that showed that there was huge demand to the point that we saw a big gap. And we came down and we started trying to fill the gap here, but kind of missed out on the opportunity to follow through to the downside. We also saw this on the SPY ETF, which represents the S&P 500. You can see that we've gapped down here today, and we've sort of found at least initial support off of this area where we gapped open from. Gaps can tell you an interesting story about low traded sessions, right? Low liquidity traded areas in markets overnight, where just less shares are trading. So I'm really curious to see how we trade here. And I mentioned in my live stream that we were likely to fill one of two gaps, either the gap left open when we gapped down this morning, or the gap that we left open from the prior week's open session as well. However, it is a dangerous trap to assume that gaps must be filled. For example, just take a look at this gap that never filled way back on the SPY. Are we doomed to come back and test that area? Maybe, but it's looking less and less likely, at least in the short term, that we're going to get that gap to fill the longer we continue to move up. And the risk to reward to shorting the market because you think this gap way over here is going to get filled can get ugly. And by the way, there's other gaps that go back like over a decade that have never been filled. So for now on the NASDAQ, it seems like we're finding support. And I think that I mentioned this in my live stream here this morning, but the initial response here in terms of a 4-hour chart level of support is I think you have several layers of support here. You have this 25,600 on NAS 100, the 25,400, and the 25,200, that being the prior all-time high. With strong GDP growth in the United States, retail sales that have been better than expected recently, and technical momentum that looks really strong for the NASDAQ. You can see recent volatility being high relative to historical ratings in the last 90 days. We can see the NASDAQ is also getting a very solid moving average confluence to the upside. Momentum still favors the bulls for now. And I reiterate what I've been doing on the channel, which is I think dips are buying opportunities until proven otherwise. Of course, that's not financial advice. And as always, with what I share in my videos, I'm not here to tell you what you should do or what you should think about in markets. What I think you should take away from my videos is some of the questions that I'm asking, and when I'm presenting my own trade ideas, take some of the things that I'm asking, the questions that we're asking, and start incorporating them into your own trading. You know, can you give, I said this in my video yesterday, are you able to give a presentation on every trade that you take and also acknowledge the bear case, right? So if I'm talking about the NASDAQ, what's the bear case here? Well, there's many. There's a lot of people who have been pointing out, you know, the Heisenberg worry, and Warren Buffett is heavy on cash. And of course, the other big one is that the market narrowness is terrible, meaning there's only a couple companies that are performing really well while a lot of companies are not doing so well. I mean, here's a look at the S&P 500 heat map over the last 1 month, and you can see there's a lot of green in a couple of the big names and a lot of red pretty much everywhere else. And this has been one of the biggest worries, or, you know, I guess bear cases, has been market narrowness, where only a couple companies are doing, or I should say a small collection of companies are doing exceptional, notably big tech names, whereas a lot of stuff is really not doing very well. But the question is that a reason, or a strong enough reason, to short this market or to bet against what has been a very dominant uptrend? And the answer for me is maybe someday, but not right now. I've said this many times in my videos recently, and I'll say it again. The seasonality here still suggests a tailwind into year's end. A lot of big investors in the hedge fund world, they sold the lows this year. And this is not me just saying that off the top of my head, but we saw massive amounts of outflows of hedge fund money selling into the April kind of panic. People in the hedge fund world had to de-risk because they were worried, hey, the economy is going to go into a recession. You know, Trump and his trade dynamics are really uncertain for this market. And believe it or not, the retail trader saw massive inflows in the brokerages. Robinhood and several other notable brokerage houses actually mentioned that, or had data that, the retail trader bought the dip. And so it's a rare occurrence where the little guy is actually winning. And so I think that as you go into, and not all the little guys, by the way, I mean, most people blow up and they put leverage on and they screw things up royally in the long term in their trading. But at least as a collective group, people who bought the dip earlier this year are sitting on massive gains, whereas a lot of hedge funds and the smart money sold the lows and is now looking at a market where, again, I think they're going to chase into year's end. Now, the reason I've said in my channel in the past, this chase for performance that we get into year end a lot of times, especially after a very strong up year, is because these big portfolio managers, hedge funds, they have to report back to who they are investing on behalf of. And imagine being a portfolio manager and saying, well, you're a big client. A big client walks up to you and says, hey, what did we do this year? How did we do? And you had to say, oh, we sold the lows in April. You would look like an absolute fool and people would move money away from you. As a portfolio manager, that's the last thing you want to do. You want to continue holding and, managing people's money. So what are they likely to do? Well, they're likely, in my personal opinion, to buy every dip they can get their hands on so that they can go to that investor and say, hey, yeah, we're in the stock market. We did really well this year, right? So I think that that is part of the reason why you can continue to see this market drive higher despite the worries that we do see. Again, the economy still seems to be holding up decently well. I know the repo rates, they're skyrocketing. You have doomsdayers all over YouTube that are telling you all the reasons to short the market, sell the market. I get it, but that has not been the right call this year. A lot of those stories have not come to fruition. And will they eventually? Sure. Eventually there will be massive sell-offs and the crash will happen. Problem with saying a crash is going to happen over and over and over is you will eventually be right. The problem is by the time you're right, the market may have doubled. And like I said at the beginning of this video, if you do want to start trading with the data that matters, the macro fundamentals, GDP growth, PMIs, and commitment of traders data to track what crowd sentiment is doing, if you want to look at full year seasonality and so much more, take advantage of the Edge Finder discount while it lasts. Again, it is 40% off for a limited time. All the information can be found in the description down below or in the pinned comment of this video. Thanks for watching. See you next time.